The Smith Maneuver is a popular strategy for investors, but recent rules from the Office of the Superintendent of Financial Institutions have made things a little bit more complicated. Joining me now is Ed Rempel, a fee-for-service financial planner and tax accountant with everything you need to know about the Smith Maneuver. Ed, thanks for joining me.
Great to be here, Barry.
Okay, let's get into this. I know a lot of people are interested about the Smith Maneuver. I feel like I first heard about it 10 years ago. I looked into it very quickly and it seemed way too complicated. You're going to break it down for us today. What is the Smith Maneuver?
All right. So what the Smith Maneuver is, basically it's an efficient strategy to use your home equity to invest for your retirement without using your cash flow. Okay, a lot of people think about it as a tax saving thing because it converts your mortgage to a tax deductible credit line or mortgage over time. But really, it's the main thing is that it's a method to save for your retirement. It should be done over the long term. And it's a quirky name, but we've done it with lots of people, and it's just it's surprising how well it works within a financial plan. So you got a retirement plan, you're able to save your RSP and TFSA, and you can only save so much, but this is something you can save on top of that doesn't use your cash flow. And it's just amazing how well it works.
Okay, so how does it work exactly? Because we got an outline here, but you're going to break it down for us.
Okay, so basically step one, you need to get a re-advanceable mortgage. Now, all the major banks have them and a few other places as well. So basically, it's a mortgage that's linked with a credit line. Okay, so normally they give you 80% of the value of your home as an overall limit, and that limit applies for all the mortgages. You can use your multiple mortgages, multiple credit lines, but it's one limit for all of them. So therefore, as you pay your mortgage down, every payment pays it down a little bit. Mm-hmm. You gain a bit of credit in the credit line, and then you can use that credit line. Okay. So then what you do is you borrow from the credit line to invest as part of your retirement. It should be a really long-term thing. So, and then the interest on the credit line becomes tax deductible. It's called a carrying charge on your tax return. Okay, so that credit line, it's not the mortgage that's deductible, it's that credit line. So, all right, then with each mortgage, it reduces the mortgage, increases the credit available on the credit line, and over time, the mortgage is replaced by the tax deductible credit line. So you start with a big mortgage and no credit line, and eventually the mortgage goes to zero, and the credit line goes up to what the mortgage started off with.
Okay.
And then, so you bit by bit, you're borrowing from your credit line to invest. And then you can also borrow it to pay the interest on the credit line. So the credit line pays its own interest and invests. So that's why the whole thing doesn't take any of your cash flow. And paying its own interest is called capitalizing. It's a term we use a lot. So, and then you get tax refunds from this. So generally, most years you're getting a tax refund, and then you should invest that. Like the standard is you always pay it down in your mortgage and reborrow because that's part of the benefit of the strategy. But you should really use the tax refund wherever it makes most sense. Maybe in RSP, maybe in TFSA, or maybe as part of the Smith Maneuver by paying down your mortgage and reborrowing. So here's kind of an illustration. So let's say you have $1 million home, you get 80% loan to values is the maximum the bank gives you. So $800,000 total. If your mortgage is $700,000, then you have $100,000 in a credit line. So you can borrow that $100,000 and invest it right off the bat. Mm-hmm. Okay. Now you're making this payment. This payment pays off a $700,000 mortgage in 25 years. And that payment, $1,175 per month is the principal portion. So when you make the payment, $1,175 of credit becomes available in the credit line. You need some money to pay the interest on this $100,000. So you leave some and you pay the interest from that, and that gives you $575 a month that you can invest. So altogether, you get $100,000 plus about $7,000 a year. That all gets invested, and it's not using your cash flow at all. And if you do this for 25, 30 years, it just mushrooms into a huge amount of money. So this is, expected benefit of this strategy over 25 years is, in this case, about $1 million. So usually over 25 years, the expected benefit is, roughly what your home value is. It's that kind of number is the benefit, and it doesn't use your cash flow. So, and here's kind of a picture of it. So, this is your mortgage being paid down. The orange is your credit line going up. So they're kind of mirror opposites. And, blue plus orange is this light blue, which is the total debt. So your total debt stays the same all the time. And so this is the investments that are being built up. And your net profit is this yellow line. It's the investment less the debt. It's this difference is this yellow line, and you see how that starts off small but builds up over time.
Okay, so you talked about some tax benefits and not affecting your cash flow. Now, are there any other benefits, or are those the two main things that people should look out for?
Yeah, the main thing is, you're the number one benefit is you're investing for your future without using your cash flow. Usually when we look at the benefits, about, let's say 20% of the benefits, 15 to 20% of the benefits is the tax refunds. Most of the benefits are that your investments, build up over time, and the investment return should be higher than your mortgage interest over time.
Right.
So, well, you can also use the tax deductions to pay your mortgage off faster if that's what you want to do. So it'll pay it off, several years faster if you take all the tax refunds and put all of them on the mortgage. So, and yeah, the long-term benefit could be a lot though, because it's, expected benefit over 25 is roughly the value of your home. So.
Interesting. Now, one question a lot of people are probably wondering, and this was something that I struggled with mainly because I didn't know what I was doing. What are the risks? Are there ways to minimize the risks?
Yes, so definitely are risks. So it's risky because you're borrowing to invest. So anytime you're borrowing to invest, it's a risky strategy. So, and basically what it does is it magnifies your gains and it magnifies your losses. And, over time, you're going to get both because you're investing in the stock market. It goes up and down. So it's, one thing, for sure, it's going to fluctuate. So there's going to be gains and losses. And when you're borrowing to invest, the percentage gains and the percentage losses are both larger all the time. So that's why this strategy is not for everyone. We found it works. It's an extremely effective tool for the right people, done the right way over the long term, but it's not something for everybody because basically you have to be able to stick with it. The main thing is you got to be able to stick with it. So if you're the kind of person that might panic and sell the first time your investments go down, then don't do this. We've had a couple people that have said, you know what, let me try it for a year or two and see how it goes. I would say, you know what, well, don't even start, with that. Like if you're going to go into it, we usually recommend, commit for at least 20, 25 years. Usually we say, yeah, commit for as long as you're going to stay in your house, like even through retirement. So you're doing it, if you're doing it over the long term. And the reason is, like, we just want to have a really high chance that this is going to work for you. And the stock market is quite reliable as a long-term investment. If you're in 25 years, the stock market's always done really well, but if you're in for 1 or 2 years, who knows where it's going to be. So you got to be able to tolerate those ups and downs. Now, tolerating them is something you can learn to do, right? So, but you got to if you can't tolerate the ups and downs, then it's not for you. And the best way to minimize it is to do it as a long-term thing. Right, to commit to 25 years or more, and because that's kind of then the market actually is reliable. And so the worst 25-year calendar year return of the S&P 500, the last 90 years is kind of the modern stock market, is a gain of 8% a year. So that's the worst 25-year period if you're in that long. So if it's of course nothing is guaranteed, but if you're in that long, you're almost for sure will have done really well at it. So the other thing you can do is just work with experts, like people that know how to do it. Like we've done this for hundreds and hundreds of people, and we've talked about it for years online. So we know exactly how to do it and all the nuances. We know how to work with. I'm also the only tax accountant on it, so we work directly for our accountants with CRA. If they audit you and you're our client, we handle it all for you. So you want to be able to deal with all those kind of issues. And the other big thing is I found that really helps is having it as part of your comprehensive plan, as part of your retirement plan. So if you think of the Smith Maneuver as part of your retirement plan, that's part of what keeps you into it long term. You got to remember there's going to be down years. You got to stick through it in the down years. And if you're thinking, this is how I'm saving for my retirement, then you're going to, save for it long term. This is just a picture of what I'm going to show you. So this is the S&P 500, the last 150 years. This is every line is the rate of return in the last 25 years. And that, right? So this is basically from 1930 on, the 25-year periods in the last 30 years. The worst one was here, 8% a year. So just showing you that to give you confidence that, it does work as a long-term thing.
Yeah, and I think what you talked about, how being in it for the long run, you can't really be in it for 1 or 2 years because, just the people I deal with, sometimes they read or they start investing. They're wondering, well, why haven't my investments gone up? I've been investing regularly for a year. Well, that's not the way it works. So it's really important for people to understand that are watching. This is a long-term strategy. And speaking of long-term strategies, and how does this affect someone's retirement plan?
Yeah, actually, that's really cool. I'll just show you an example. And it's funny, a lot of people may not even have seen a retirement plan. So this is a slide I often show just to compare the difference between why people need to be in equities versus balanced. Basically nobody can retire with a balanced fund. But this is an example of a reasonably comfortable retirement for a married couple. So they're 35, they're married, they're 100,000 each, so 200,000 together. They want to retire at age 65 on 75,000 each. That's 150,000 total. Okay, so they're retiring in 30 years, and we're going to assume 3% inflation and the maximum government benefits and all that. So see, just to give you an idea, if they were investing normally without Smith Manoeuvre and with a balanced portfolio, they would have to invest. They would need getting, let's say, 5% return. They need to get to 6.7 million. They have to invest 100,000 a year. That's half their gross income. Ridiculous. Yeah. So when you go to stock market, they need to get to 4.5 million. That's 40,000 a year. That's 20% of their income. So it's basically maximizing their RSP and slightly more. And that's really all that they need to do ordinary. But it's still 40,000 a year that you need to invest. Okay. Now let's take the same couple and add the Smith Maneuver. So now we're saying they have a $1 million mortgage. We're saying it's a $1 million home, $800,000 mortgage. Just start with zero Smith Maneuver. $800,000 mortgage, paying it down over 25 years. And so this is without the Smith Maneuver. With the Smith Maneuver, now they need 4.9 million instead of 4.5 because the extra 400,000 pays the interest on the tax-deductible credit line after they retire. But they only have to invest 20,000 now instead of 40,000. It's only 10% of their income. So that's the difference. It's 20,000 by adding the Smith Maneuver. It's 20,000 less that they need to invest to have the same retirement. So let's show you how much of a difference it makes.
That's really interesting because that was the whole point of the Smith Maneuver. It's kind of like a hack, but at the same time, it's not. It's just maximizing the cash flow if you've got enough equity in your home. But the reason the Smith Maneuver has been in the headlines a lot as of late is because OSFI has introduced new mortgage rules, from what I understand. What are those new rules?
Yes, there are new rules, and they're going to affect it. So let me just kind of explain what they are. So essentially with the rule, it's a little technical, but what it is basically, so they call a re-advanceable mortgage a CLP, is what they call it. And what they're going to say is if you owe more than 65% of the value of your home, then, or the total credit limit is more than that, then it's not going to re-advance dollar for dollar. So every dollar you pay down on the mortgage, you don't get quite all of it back in the credit line. That's what's going to happen. Okay, so we'll affect the Smith Maneuvers somewhat. So now, so if your mortgage payment reduces the mortgage payment by 1,000, your credit line is going to increase by less than 1,000. And basically, what they're trying to do is reduce the amount that you borrow, your total limit, from 80% of your home to 65% over time. When we say over time, they do it over the amortization period of your mortgage. So if you're paying your mortgage off over 25 years, it's paying it down over 25 years, which is pretty slow. So now this is effective when your mortgage comes due after October 31st, 2023. They said after this October or whenever the bank's year end is. So, and all the major banks have the year end October 31st. So, if you have a mortgage today that doesn't come due for 3, 4, 5 more years, this doesn't affect you until that mortgage comes due. So it's not immediate. And so we have a fair number of clients actually who've been renewing mortgages now quickly before October 31st. So, okay, they're good for a few years. So it just delays it.
Okay, so this is really interesting because October 31st is like less than 2 weeks away. Like you said, it doesn't affect the people who already have renewed, already have a Smith Maneuver. But how about those people who are thinking about the Smith Maneuver and they're renewing after 2 weeks? How do these new rules affect the Smith Maneuver moving forward?
Right. Okay, so here's what happened. So bottom line, the effect is going to be fairly moderate. Okay, so now if you maximize the Smith maneuver, which most people do, they kind of use all available credit as they can. It's going to mean that you're investing about 20% less than you would otherwise.
Mhm.
Worst case scenario, so if your mortgage is really small, it could do it as much as 45% less, but most people are try to maximize it. So just think of, in the case where your mortgage, you pay $1,000 of principal every month, you probably get to reborrow 800 from the credit line instead of 1,000. So, and then once your total credit limit is down to 65%, then it stops affecting you. All right, so the effect isn't large. In fact, this year interest rates have really shot up a lot, and for people doing Smith maneuver, the much higher interest rates is a much bigger deal than this rule change.
Yeah.
But
It's funny you talk about that because we're talking about what I think interest rates right now are hovering around low 6% up to 6.5%, and
mid
you're
higher
talking,
or high,
yeah, whatever. I haven't looked in a while, and you're talking about the average return being 8%. The spread is getting very thin, right? So people are probably questioning it. So these changes are a good thing, but is there like a formula to figure all this stuff out, or what?
So, you're actually right, because we had just a couple of years ago, we were getting mortgages at like 1.5, and people were investing in the stock market. In fact, back then, the stock market in 2020 had an awesome year, right? So it just seems like if the interest rate is 1.5, Smith Manoeuvre seems like such a no-brainer. Now it's 6.5. It's like, oh, okay, well, I'm making 8. Now, 8 is kind of a conservative long-term number, but you're still ahead actually from doing that, just so you know, because the 6.5 is fully deductible each year.
Right.
And if you make 8, so it's really costing, 3.25. And then your 8 is you pay capital gains on it, and you can mostly defer that way off in the future if you invest very tax efficiently. So you're still gaining a good a good amount all the time. So now, so the formula here on this on the OSFI. So here's kind of the formula. There's 2 steps. So just follow me through a little bit. So first of all, they define it as a total credit limit is 80%. Okay, that's what it is in most cases. And right now, even all of the reinvest mortgages have a variable credit limit, which is the credit line. The credit line portion can only be up to 65%. You can get up to 80% if the difference, at least 15% of it's in a mortgage. Okay, but these are the definitions: total credit limit, variable credit limit. So what they're going to do is they're going to reduce the total credit limit from 80% to 65% over time based on your mortgage amortization. Okay, so then there's the loan to value, LTV. So that's the amount owing between your mortgage and credit line, the total that you owe as a value, as a percentage of the home based on whatever the last appraisal the bank did. Okay. So now to figure out how much when you pay your mortgage down, how much of it you can reborrow, there's 2 steps. So first of all, the reduced credit is you take your principal payments. So let's say you were paying $1,000 a month of principal down, times 80 minus 65. That's this difference, whatever this difference is, divided by the loan to value of your mortgage. Okay. So I'll give you an example of this in just 1 second. So, and then what they do, that's the reduced credit, and then the credit that you get is whatever the principal payment was minus this reduced credit. Okay, it's kind of 2 steps. So okay, let me give you an example of this. Okay, so here, let's say you had $1 million home based on the last appraisal, mortgage is $800,000. Okay, no credit line for now. Your loan to value is 80%. That's the LTV. Your payment is $5,334 per month, and so your principal is $1,000. Okay, you paid out $1,000 of your mortgage. So now the reduced credit is the principal payment, that's $1,000, times 80 minus 65, which is 15%, divided by the loan to value, which is your 80%. So it's $188 a month. Okay, so now I take my $1,000 a month minus 188. So now when I pay $1,000 on the mortgage, the credit line limit only goes up by $812. Okay, so I can still invest the $812. Okay, so I'm investing $812 instead of $1,000. See, not the end of the world, but it is somewhat lower. So now here's what I'm going to go a couple examples of what happens. Let's say you keep this mortgage for 25 years. So this is now a few years in. Your mortgage is down from $800,000 to $700,000. Your credit line limit's at 80 because your total limits, that the maximum that they've allowed you has gone down from 80 to 78, starting to decline. So you can only owe 780. So that's the total. The loan to value is now 70% because they're looking at the mortgage part only, the mortgage part for this loan to value. And then now your principal, it's the same mortgage payment, but it's paying $1,500 of principal because the mortgage is smaller. Okay. So, but you have to use a bit of it to cover the interest of the credit line. So now your reduced credit is this 1542 a month times 13 over 70. So 13 is the 78 minus 65 divided by the 70%. So 286 a month is the reduced credit. And so you paid 1542, you get 286, and it's 1256 a month that it readvances. So now some of this you have to use to pay the interest on the 80,000. Okay, so you can't quite invest all of it, but now because we're maximizing this, you'll see this difference here is still 20%. 1256 instead of 1542. Yeah. And now let's go to, so the mortgage is almost paid off. Okay. The mortgage is down 150,000. The credit line's at 530,000. So now the limit is 680 because it's the limit started at 80. It's almost down to 65%. We're down to 68%. So you're still making the same payment. Now it's paying $4,500 a month of principal. Okay. So $4,500 a month of principal times 3, it's 68 minus 65 over 15 is $900 a month. So it's now you're paying $4,500 principal less $900. So you get $3,600 in the credit line. Again, it's a 20% difference. So you see that 20% difference kind of goes all the way through.
Okay, so what's interesting when looking at these monthly examples, so people who are interested should, I guess, kind of like the main takeaway is overall, you can still do the Smith maneuver, but with these new rules, you're looking at 20% less that you can borrow, roughly speaking, regardless of how big or small your mortgage is, which is great news for people who are interested in the Smith maneuver. But can you talk about like the best and worst case scenario? Because, some people are excited about these, but they got to look at things on both sides, right?
Yeah, actually, just let me show you one more thing here. So the effect on your investment.
Okay.
So this is those examples I just gave you. That's the new credit that you're getting each time.
Right.
Okay. But this is how much you need to pay the interest. So this is at 80,000. This is the higher amount, whatever the higher amount, I think it was higher amount of credit that you have. So this is the amount that you can invest. And now, so where this is unique, so it used to be that, so on the first payment, you paid $1,000 a month of principal, so you can invest $1,000. And then next month, you've got a little bit of a credit line, you have to pay a little interest, but you pay down slightly more than $1,000 of principal. But basically what happens is that $1,000 a month that you invest is a constant for 25 years. Okay, because as the mortgage declines, the credit line raises, and it's a constant. Now, what happens because of these rules, you see the amount that you invest, it declines over time. Now, this is, over like 20 years, but it's cut to close to half the amount that you're investing. So now with Smith Manoeuvre, you're going to have to monitor more closely how much you're investing. So it declines very slowly at first, but a little bit faster later on.
Interesting. So let's talk about those best and worst case scenarios.
So this is the best and worst case. So the best case is your mortgage is an 80% loan to value. You're maximizing everything. Then you get 20% less credit. The worst case is if you have a small mortgage, but you still have an 80% limit. If your limit's down to almost 65%, that won't affect you much. But if you still have the 80% limit and a small mortgage, then the credit available is going to be about 45% less. So that's kind of the worst case scenario. It's almost half of the difference.
And what would you say is the easiest way to manage the whole process? Because I think a lot of people are watching this, they're very interested, but there's a lot of moving parts, right?
Yes. Yeah, it does make it a little bit more complicated here. But yeah, there are some ways to deal with it. So and also just to manage it. So first of all, your credit, the amount of credit that you reborrow, the new credit you get in the credit line, there's two uses. Part of it is to capitalize, like to pay the interest on the credit line, and part of it is to invest. Okay. So your options to adjust on this. So one thing is you could just invest 20% less each month. That's fairly simple. And then you're going to have to reduce your investment a little bit more, but you can basically do the same thing, just invest a little bit less. and still run it the same way as normal. The other thing you can do is just increase your mortgage payment a little bit. If you increase your mortgage payment by about 4%, you'll still get that instead of 812, you'd be paying $1,000 a month of principal. Just pay that extra $200 on your mortgage, and now it works out the same. You just got to paying a bit more, paying the mortgage off a little bit faster, and you still end up investing the same amount that way. And then it's a good idea here. You could probably going to want to keep a little extra credit on the credit line, just because the amount you're getting is declining slowly.
Right.
So leave a few $100 in the credit line and don't use up every last dollar of it.
And are there any ways to minimize or eliminate the effects?
Yes, there's a few cool methods. So one thing is, this what I mentioned before, is just renew your mortgage before October 31st and then renew it for several years. So although it's funny, it's a weird interest rate market now. So lately we've been doing 2 or 3 year. Actually, right today we're doing 2-year fixed, because we think mortgage a year from now they're not going to be lower, but 2 years from now they probably will. So that's what we're doing. Ideally, it'd be nice to do a 5-year now, or a 5-year variable or something. But the variable rates are not that good, so we're not really recommending them. But basically, if you renew your mortgage now, then you don't have to worry about this for several years.
All right.
Another thing you can do is you can reappraise your home, every few years, and then, but then don't increase your total limit. So if you just go to the bank and get a reappraisal, but don't increase the limit, then once your home rises by 23%, then you're actually automatically going to be at 65% instead of 80. With the same limit that you have today, you'll be at 65%, and then these rules don't apply anymore. Okay, so now typically in Toronto, the real estate goes up, I don't know, 3, 4, 5% a year, a long-term average. So about every 5 years, this should happen. So if you renew your mortgage, get your home reappraised in 5 years, you get a bit of an increase, and then you don't have to worry about these rules anymore. That's one way. The only thing about it, though, is for most people doing Smith Maneuver, once you reappraise your home, you probably want to, get extra credit. You probably want to invest that amount. So that's what most, growth-focused people do, and most people doing Smith Maneuver are focused on that. So if you're going to keep investing it, well, then it's still going to always affect you. But then you're kind of almost restarting it, from the beginning every time you reappraise it and increase it. The other thing you can do is create split mortgages, because it's looking at the total of the mortgage is what it's looking at, and how it's slowly paying it down. So remember the examples I had. You start off with a big mortgage, and then you end up with quite a big credit line. But what you can do, we actually very often do, is see with the same readvanceable mortgage, you can have multiple mortgages and credit lines. So what we do is we take the credit line, once it's built up to 200,000 or 300,000, it's built up a reasonable amount, we make it also into a mortgage. So it's still within the same overall readvanceable mortgage, but now you have 2 mortgages and 1 or 2 credit lines, and the 2 mortgages take up almost the full 80%. Okay, so and then one of the mortgages is tax deductible, because it's the money that you're going to invest, and one is the money that you use to buy the house, and it's not deductible. Mm-hmm. But if you keep having 2 mortgages like that, then the effect of this is quite a bit less than it would be otherwise.
Okay, so this is really interesting. The Smith Maneuver has a lot of tax benefits, but there's also the tax-free savings account where Canadians can invest tax-free. Is there like a difference, or what's the effect of the Smith Maneuver versus the TFSA?
Right. So this is actually quite interesting in a financial plan, because we always look at, let's say you have extra cash and you're doing the Smith Maneuver. So you have extra cash, you can put it in your RSP, you can put it in your TFSA, or you can put it into the Smith Maneuver, which means you make an extra mortgage payment and you re-borrow from the credit line and invest. Okay. Now, all 3 options, you can invest exactly the same. So the only differences between those 3 options are tax differences. Okay. So now, with the way under today's rules, before those rules take an effect, the Smith Maneuver generally beats the TFSA for people that invest tax efficiently. Okay. So if you're investing, you're not investing for dividend, but you're investing for long-term growth, for deferred capital gains. That's the most tax-efficient way to invest. And then those people generally get refunds in most years. So that's why Smith Maneuvers usually beats a TFSA under today's rules, because you generally get a refund, while TFSA is no tax. Smith Maneuver is you get a refund most years. Okay. So our rule of thumb planning for clients is, for people in the lowest bracket, if you've got extra money, you do with Smith Manoeuvre first, TFSA second, non-registered investments third. You don't do RSP if you make less than 50, if you're 53,000 a year. So now, if your income is at 30% or higher, so your income's over 53,000, your taxable income, then RSP is number one, Smith Manoeuvre is number two, and TFSA is number three. So notice Smith Manoeuvre is always ahead of TFSA, and RSP changes. So that's the old rules, or today's rules. Now, under the new rules, here's what happened. Under the new rules, TFSA generally is going to beat Smith Manoeuvre now. So that's the difference. Instead of Smith Manoeuvre being better place to put your money, TFSA is going to be better. Okay, and the reason is, if I put my money in the TFSA, 100% of it gets invested, right? But if I put my money into the mortgage, only 80% of it's invested. Okay, so that's the difference. So all of a sudden now TFSA beats the Smith Manoeuvre. So it's TFSA is for low income people. TFSA first, Smith Manoeuvre second, non-registered third. If you're a bit higher income, RSP first still, but then TFSA, then Smith Manoeuvre. So old rules, the general guideline was no TFSA contributions unless your mortgage will be paid off before retirement. So always look at, is it going to be paid off before you retire? And once it is, then you start doing TFSA. But if your mortgage is still going to be around, then you do this first. Under the new rules, basically no mortgage prepayments until your TFSA is maximized. Mm-hmm. Okay, so it actually changes what we do.
And of course, you obviously need to own a home first more than anything else too.
Well, yes, if you need to have a home, you have to readvance the mortgage. So this all assumes that you're already doing the Smith Manoeuvre, and now you have some extra money. Right. Where do you put it?
Okay, so Ed, can you quickly summarize the Smith Manoeuvre, the new rules? I don't think we need to go over new rules. More or less just quickly summarize what the Smith Manoeuvre is, because I know people just love it.
Yeah, so Smith Manoeuvre it's a really effective way. It's a really efficient way to invest for your retirement without using your cash flow. It's a great addition. It's a really effective addition onto your retirement plan. And we've done retirement plans for lots of people. And what we find is we look at the way they want to retire and what they're doing, and they're going to be short. Then we add Smith Manoeuvre. It's surprising how often that makes the difference. So it's a really useful thing in a financial plan. It's a very effective strategy for the right people done the right way over the long term. It's got risks, but you can deal with them if you can tolerate the ups and downs and you invest long term. And it's just a great thing to do. The new rules are just going to reduce it maybe 20%, but for a while until you've gained some extra credit in there or whatever, until the home value goes up. But the strategy will still be very effective.
Okay, Ed, and where can people learn more about the Smith Manoeuvre, or more importantly, about you?
Okay, so I have a blog, YouTube channel, and I'm actually opened a podcast this year. So my blog is it's the number one blog in Canada for a financial planner. It's edrempel.com. I've got you can get a free consultation if you want to talk to me. edrempel.com/talk. The YouTube channel is edrempel.com/watch, and podcast is edrempel.com/listen. So really easy to remember.
You've got a lot of places where people can find you. I know we met online. We've now met in person. Ed Rempel, fee for service, financial planner, tax accountant. Thank you for joining me on the Canadian Financial Summit today.
Always great talking to you, Barry.